Well, today the Bank of England refrained from adding any more stimulus to the UK economy despite entering a deeper recession. Joining me now to discuss the UK economy alongside some of the latest data to come out is Ross Walker, Senior UK Economist at RBS in London. Ross, thank you very much for joining me. Now, some economists deem this rate decision today as a non-event compared to the ECB meeting, but the situation has deteriorated in the UK, piling pressure on the Bank of England to act in some way at some point soon. So we're in a slight wait-and-see mode, but looking ahead, what do you see as being the Bank of England's preferred weapon of choice? Are we still looking at more QE, or is a potential rate cut again in question?
Well, my sense is still that further QE would be their preferred policy course, supplemented with the new credit easing funding for lending scheme. So if we were to get further easing, I think firstly that's likely to come in November rather than before, and it's more likely to be more quantitative easing rather than a bank rate cut.
The funding for lending scheme only started yesterday, which is hoped to help boost the supply of credit and stimulate the economic activity in the economy. Now, could the FLS initiative be the start of a new approach to the economy's problems, or are you slightly pessimistic that banks will still be reluctant to lend?
It's very difficult to know exactly how the scheme, what benefits the scheme will bring, to quantify them with any confidence. I think it's certainly the right thing to do, and the way that policy is evolving, with the emphasis not just on making gilt purchases and lowering or pinning down the risk-free rate, but also trying to ensure that the interest rates being paid by the real economy, both the business sector and households, are also kept low. So it's the right decision, and it's in response in part, I think, to the rise we saw throughout this year in real-world interest rates, which was in itself a reflection of higher term funding costs for banks. So the FLS, I think, is the right way to proceed, because it addresses more directly that problem. I think in the short term the key issue is still to what extent at the moment is there demand in the real economy for these loans.
What about the weak manufacturing figures that came out this week? Manufacturing activity declined in July, with production falling at its fastest pace since March 2009. Now, we did see a pickup in June, so what's the main factors behind this decline? Is the Eurozone market the main culprit to blame here?
I think the Euro area difficulties are certainly a significant part of the problem, and we saw in that PMI survey an even sharper fall in export orders, a bigger fall than in domestic orders, with anecdotally a lot of that weakness relating to the euro area. There are also some reports of a slowdown in demand from Asia as well, but it's principally a European story, so that's part of it. The scale of the fall was a surprise. It may be that there is a delayed Jubilee effect in these numbers and maybe some distortion from the Olympic, or it may be simply that a number of manufacturers have decided, given this point in the calendar and the clustering of these extra holidays, that this is an opportune moment to do any routine maintenance work. So it's maybe we have some variations in timing of summer shutdowns that may have had some downward effect on the survey. But even looking through all of those distortions, it's still hard to avoid the conclusion that there has not been some underlying deterioration.
What about the UK housing sector? How is the market holding up? Also, how will the funding for lending scheme impact the housing market?
Well, the market in general is still fairly subdued. If you look at housing transactions or the number of new mortgage approvals being granted, these things are running at roughly half their pre-crisis levels. On the pricing side, there's been a much smaller adjustment. House prices outside London have come down, but the falls in the UK are typically more modest than what you've seen in other economies which had similar housing booms pre-2008. So I think the story here is still that the very low interest rate costs has meant that in aggregate mortgage funding costs are still anchored close to historic lows, so financing that debt is relatively straightforward for most people. So it's on the one hand it's a weak market in terms of activity, that's sluggish, but signs of stress and payment difficulties are still considerably more benign than, for example, in the early 90s recession.
Also, Ross, the much anticipated Olympics Games kicked off at the end of last week. Now, this was expected to boost the economy somewhat in the coming quarters. However, initial reports suggest the retail sector isn't receiving the Olympics bounce or boost to the businesses and consumer sector that was previously expected.
Yes, I mean, the data are still quite thin. Most of the surveys the markets watch typically only cover July, so at best you're capturing that period just before the Olympics. There have been anecdotal reports and certainly no shortage of photographs of relatively empty-looking central London shopping streets. We'll have to see just how much that persists. I agree in general that the benefits for those consumer-facing parts of the economy, whether it's the travel and tourism or retail side, on the basis of the early evidence, do seem to be rather less significant than might have been hoped. So there's still a huge amount of uncertainty around the Olympic effect. I mean, overall, I would say that the risks are that we see a smaller rebound in economic growth in the third quarter than might have been expected.
Right now, the UK's prospects are looking quite bleak. Now, what are the main factors, in your opinion, holding back the economy, or shall I say, stunting its performance, looking at both internal and external factors?
Well, externally, you've seen global growth slow, and particularly in the euro area, and UK and European growth rates are broadly similar at this moment in time, and that's typically what you'd expect. It would be quite rare for the UK to significantly outperform the euro area for any protracted period, simply because we do so much trade and other business with continental Europe. Domestically, we still have this balance sheet adjustment. Households and the government are engaged in trying to reduce debt levels, certainly reduce borrowing levels in the case of the government, and that is inducing some dampening effect on economic growth. And both of those factors, the public sector fiscal adjustment and the household sector deleveraging, these are going to be themes that will be with us for some time, certainly for most of the rest of this decade.
Ross, thank you very much again for joining me and sharing your comments there on the UK economy going forward. Now, coming up on DukascopyTV, Natalie MacDonald will be discussing potential policy moves by the ECB, and we'll have more on the Russian economy as well as the US job sector. But for the moment, goodbye.